Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Well, welcome to March 1st of 2022, and we've made it. It feels like it's been a year already if you're following the equity markets or any other market for that matter, because there's been a lot of volatility, a lot of highs and a lot of lows, depending upon what markets you're looking at, everything from cryptos to real estate to now the U.S. equity market. Volatility brings on uncertainty, which brings on opportunity, but in the short term, we have to get through and riding through what we saw, especially at the beginning of the year, January and February, not so favorable for many asset classes. That being said, we have a diversified and balanced approach here at Blanke Schein Wealth Management, so we're navigating and we're definitely used to the volatility here for our clients. Now, looking towards the future in March 1st, we have obviously in the headlines a lot of geopolitical pressure right now and tension, to say the least. And our thoughts and prayers for anyone that's effective, both here and especially overseas, with regards to the geopolitical crisis that's happening right now. And that's then sparking what we're seeing, which is oil prices today just shot through 100. They're about 104, 105, depending upon where we land today. What do oil prices ultimately mean, Rob? Well, not only is it a tax on you and I and those around the world that are consuming sort of gases and gas prices are going up and it's going to hit us at the pump, no doubt, but also corporations. We're going to see if that persists. If this stays above 100, because there is some research that points that once oil hits over $100 a barrel, it then sort of projects or predicts an impending recession at some point in time. And now, if it stays above, and it doesn't always happen that way, but it is definitely concerning. If it persists for quite some time, it'll weigh on corporate earnings, the consumer, so on and so forth. So right now, we have a present oil shock. We want to put this on our radar. In the meantime, starting in March right now, we have what to watch. We're going to watch the yield curve, because that's also probably one of the better indicators of what a recession would look like. And ultimately, what we pay attention to are short-term interest rates versus intermediate-term interest rates. So the 2 years versus the 10 years. Now, we all know that the most predicted rate hike is going to happen in just a few weeks right now when the Federal Reserve meets mid-month. And we're going to pay attention to what they say, because the calculus now has changed over the last 4 to 6 weeks because of the geopolitical tension. So what was 4 weeks ago, all the Fed talk about a 50 basis points rate hike for the month of March is now all the way dialed back to a zero probability of that happening. Actually, it's going to be 25 basis points, and the Fed has to move because inflation is still closer now from 7 to 10% on a lot of things that we're seeing across the supply chain. Again, the gas prices and higher oil and energy costs do not help at all. So that forcing the hand of the Federal Reserve, but they have to go slowly, because if they raise interest rates too soon, meaning that the shorter end of the yield curve goes higher than the longer term of the yield curve, the 10-year, the 2-year versus the 10-year, that's what I'm talking about. So if interest rates rise higher than the longer, that's called an inverted yield curve. That then sort of is a precursor to a recession. Again, not 100% indicating, but if you take the first two, $100 a barrel of oil, and then watch the yield curve, and if those two are predictors and those two hit, let's say, and then even the next year or so, and stay above those trend lines and they turn negative, then we have an impending recession. Right now, we got to look at the data that's in front of us. Corporate earnings are still strong. Consumer is still strong. In fact, as most recent as the IMS number came out this morning, and it was a 58.6, higher than even the projected 57.6. And that shows that there's 21 consecutive months of growth. Now, inside the report, now keep in mind, anything over a 50, it means that your economy is expansionary, so it's good. Shows that the consumer is solid. And inside the PMI report, Purchasing Management Index is also showing that there's some inventory and supply chain sort of easing, if you will. So that means that consumers can get things a little bit faster, inventories are building a little bit better. So there's easing on that. If that eases, we're going to see that sort of inflationary pressure subside. We also believe that the consumer is going to burn through a lot of the stimulus that they've seen. And so you'll have less dollars chasing more goods and services. Therefore, that imbalance could help out the Federal Reserve. And maybe instead of doing 5 or 7 interest rate hikes over the next course of 24 months, maybe they just moderate to about 4. That's our base case. So we'll see what they say again later in a little bit in a 2-week period right now. And finally, as we're in March, we need some good news, because obviously the reality and the headlines and who knows about the State of the Union, You tell me. We're going to watch and tune in to see that tonight. But I'll give you some good news right now. We made it to March, and it's one of my favorite times of year because it's March Madness. And why that's important? Well, I think in March Madness of 2022, like we saw the Super Bowl, we're going to see March Madness in full swing. And that means that masks are coming off. That means that people are actually leaving their houses. That means the economy is now rolling. That means that consumers will spend. Ultimately, that'll work its way into corporate balance sheets, and then profitability will happen. That's what we see, because we are still, keep in mind, on a reopening of what we haven't been able to do. We predict that travel will be tremendous this summer. Probably the biggest that we've seen in the travel industry for quite some time, just because a lot of people haven't been back to traveling. Business travel hasn't even come back online. So there's a lot to be sort of looking towards the future right now in terms of what could happen. And don't count the markets out just yet. I think there's a tremendous opportunity. And in my note today, it's important to note that once we have a geopolitical crisis like we're seeing right now, or some discord on a global level, historically speaking, going back the last 50 years, that has been the exact time where the S&P 500 at the very beginning of one of a crisis or geopolitical discord has happened. All of the sample sets have showed that's been the low in the market. So that's exactly when you want to pick up some bargains, because a lot of stuff is on sale right now. That's exactly when it's the heighten of uncertainty, right? The fog of war, the worst case scenario that's playing out right now. But historically speaking, if it's our guide, again, it rhymes with history in terms of markets, and we take a look at that. We pay attention to that. Historically speaking, the S&P is usually at its all-time low, or a good buying opportunity in the height of the headlines, in the middle of the tension right now. Again, thoughts and prayers for everyone going through this geopolitical process and issue around the world. We think and we pray and we want this to resolve obviously very peacefully, but who knows how this plays out. From a disruption standpoint, again, our clients were not exposed to Russia or even Ukraine, internationally speaking, so we're well out of that exposure per se, and so right now it's just a humanitarian and sort of a crisis on defense, and how the rest of the world sees to come together. Coalitions being built, and hopefully take out the bad guys, the bad actors right now, so that we can have some peace moving forward. So that being said, thanks for watching. That's our update as to what we're paying attention to. Markets are paying attention to too, as you should. So thanks for watching. Take care. Have a good day. Happy March.